And starting recording. Okay, here we go. All right, so this is Ken on April 22nd, 2018, 7:15. Um, and this is the FAQs and swing presentations for the advanced swing course. I think what I'm going to do on this one is I really like the discipline of a 7 o'clock on Sundays. And even when I get it back into the soccer swing, that's usually going to be a time that I'm available. So I think I'm going to just keep doing this Sunday nights for swing trading, and I'll figure out a way to get this sort of a like an ongoing question and answer session. So it won't necessarily just be tied to particular lessons, but there will be like an ongoing um, aspect of Q&A. I'll figure out some way to organize the FAQs into clusters. That may be maybe something we do with an intern. Have somebody on a scholarship kind of try to organize those notes into topic clusters. I'll give some thought to that this week. Okay, so let's just go ahead right into it. I'm going to go back and knock out the questions from lesson 7 as well as 8 today, so we can have a document, get them all documented. So the first question was about ETF2. What am I doing with it? Well, what I do is I still compute the model asset allocation percentage for the weekly report, and I compute all of the components of that ETF2 model. So that is the strength, consistency, and quality on a scale of 0 to 100, and then roll that up into an aggregate um, average rating. And I really like that as a supplementary and complementary perspective on the world market model. I think we get some of that with the blended monthly rebalancing anyway. And the blended monthly rebalancing calculation is the calculation that I use for strength. But what I find is that the ETF2 model adds in a couple of the other supplemental things, like the 10-week moving average and the system quality, the 40-week system quality number. So it does actually have some other elements of interest in it, and I like having that, like a diversification of the insight. And so I like that method of quickly categorizing elements of the world. It gives us the insights not only into sectors but also the world market model itself uses the that strength element to take a look at the um, relative strength of things around the world by geographic region. I have some subsets of that also look at like the XL sector spiders and so on. So I think it gives us insights into those as well. And if you remember that quiz, I really like um, the source of ideas on a strategy basis for really like swing and longer term position trading. And I think that it gives us some insights there. In the same way that there is a core and turbo between swing trading and day trading, there's also a core and turbo between that longer term position trading and swing trading. So you can take a look at things that are in the blended monthly rebalancing, for example. And those candidates that are really dominating week after week, month after month, well, it stands to reason that there's a swing trade in there somewhere. And so you can add a turbo position to that by using any of these methods that we're talking about here. The P4 method usually works on that. And the MACD histogram continuation, when you get the uptick above the zero line, there's an opportunity to add a swing trade there while that thing is back into the growing phase. It's already above average, but then it's starting to grow. And so if I were to draw a picture of that, if I can, let's see if Yeah. So if we've got the zero line, something like this, and the MACD histogram is MACD histogram is above it, for the bars. That means the signal line is above the zero line, and then it falls off and then starts to resume. And if we take a look at if the red one were to be the 5-period moving average on this, using our little RLCO frame of reference, that when it crosses back over, you're on caution. But then when it resumes, and you get this move where it pauses and refreshes, and the low never gets down here below the zero line, this move right here now becomes a place that you can add to the position. Well, if this thing has been long and strong, with relative strength, looking at the 3 and the 6 month look back, you might have that position in ETF2 or blended monthly rebalancing. And then you see a moment like this right here at point A, and you say, well, that now becomes something that I can add a turbo position. So I really like ETF2 for that reason. It gives really good insights. I've never really been surprised by anything in the news about what sector or what country is really doing well, since I've been using that thing for, gosh, it's almost 20 years now, some form of that. It's been very, very helpful. Let's see. New image. Yeah. So I think that's what I use that ETF2 for. It gives me candidates for that longer term swing trading, gives me insights rapidly into understanding the world market model. It itself is a reasonable asset allocation model. And then the risk model in there, by looking at those 10 indexes of the world and getting a quick estimate of how many of them are above their 4-month moving average, gives you almost a down and dirty volatility estimate too. I think we get that already from the risk Z, but that's a nice way to get an independent validation of it. So like right now, it's at 40% exposed, 60% cash, and that's actually a pretty good posture to be in terms of how aggressive do you want to be on swing trading right now. It suggests that there's enough volatility baked in that you're not going to get long swings, so you ought to be taking a look at reducing positions, being more quicker to lock in the gains when you get them, because it's only, we're only 0.5% above the sideways market anyway. So it actually has a pretty nice history of monitoring the world pretty broadly. Yeah, Griff, that's what I would suggest. I think the BMR is a nice way to look at it. ETF2 as well. That's sort of the basis of my long-term posturing. Now I supplement those with swing hedging because I look at the market enough that I don't feel like I have to kind of go to sleep for a month at a time. But when I get to the asset allocation here in a minute, I'll show you that I can leave those positions alone because I'm trading around them with core and turbo, and that protects me in the longer term positioning. Right. So, yeah, for a while there was a hedge fund that was following those things religiously on a weekly basis, and the nice thing about that, emotionally for me, was that in the 2003 meltdown and the 2008 and 9 meltdown, there was a lot of people saved a lot of money by following those signals. It's a conservative growth strategy. It tends to underperform buy and hold during long periods of bull markets, because there are quite often some 7 to 10% pullbacks in the leading sectors that can cause you to take a hit, and then it doesn't fail, and then it resumes, and because you you took a stop loss there, you tend to underperform a little bit. But where it's really saved people's millions of dollars was in the reduction of exposure prior to the explosive sell-offs. So there's some long-term goodness in that system that we should not just dispose of, in my opinion. Okay, number 2, trading proficiency. In the outstanding video from Alex, trading is a skills-based activity. Alex mentions that it took him about 800 simulated trades before his profitability improved. How long, in terms of number of trades or time, does it take for the average trader to reach that proficiency? I would say that's about right. I mean, I'm thinking of 3 different people besides me that have taken hundreds of trades to really sort it out. In the Frog system, and that's intraday, Matt Blankenship traded 800 trades in 4 months and used that. And at the end of that, he had a real sense of what would and would not work for him. And he was able to sort of trade the Frog in the morning and go golfing. And he had a set of trades that he was satisfied with and still uses to this day, last time I talked to him. Kim Anderson was somewhere around the 600 trade number when she just got so tired of giving back gains that she implemented what we called at the time ruthless risk management, and she just got vicious about protecting against giving back her gains. And a natural consequence of that was the development of her bounce system, which really emphasizes ruthless decision making when you get a hesitation. And so her trading histogram, her equity curve, was looking something like this. She would go through a period of time it was really gaining, and then gave back a lot, and then it would gain, and then gave back a lot, and then gained, and then gave back a lot, and then gained, and then gave back a lot, and then gained. And so there was this kind of steady upward performance. But these gains that she was given back here, she did not like that at all, and she didn't like, giving back, these elements too, the excessive losses. And when she implemented ruthless risk management, right about, she had something like, it was right around the 600 trade mark. And her numbers, instead of doing this, it just kind of went, and the equity curve just looked like that. So she was not giving back these great big sections of gains. And so it was a combination of decision making to be ruthless about risk management in the moment on a trade by trade basis, but it also was monitoring her the life cycle of her equities. So it's almost in the same way that if you look at the market right now for this year, if you said that's what it's done, there was a period in the first 3 months up to about the middle of March, 2.5 months, it did this, and then kind of did this, and that's about where we are right now. So you have these 2 really separate and distinct time periods. I should move that a little bit. Yeah, 2 separate and distinct time periods. Well, if that was your equity curve, one of the things that you would be concerned about was if you had back tested, or your historical performance was that it should look something like this, and instead of it coming back, after this period right around in here, instead of it coming back to the normal, you keep getting these excessive gains. You might say, oh, well, maybe I'm really just outstanding and amazing. Or you say, the market is giving me an unusual continuation pattern here, and it's becoming extreme itself. And so the very things that are gaining the most are likely to be the things that fail the most when the market itself changes. And this happened once again right around March 10th. It seems March 10th and 11th just historically has not been good for the market. 2003, March 10th was a tough day. Um, so that ruthless risk management uh, on a trade by trade basis, and then monitoring the performance of your portfolio to know when you have excess gains, is a time to start really refining um, and refreshing your rules about risk management, especially when times are good. You know, in the Bible, the 7 years of plenty followed by 7 years of famine, that you got to patch the holes in the boat or in the barn to protect those gains before the losses hit. So I come back to this and I would say, so between Alex and Kim and Matt and myself, I really think 600 is probably not surprising. And I think it takes that many to go through a couple cycles of um, optimism and pessimism, and then confusing luck with skill, and then seeing different market conditions and getting some of those lower probability fat tail events to see how it works. You got to get some earning cycles in there and some system shocks and changes of policy or whatever it may be. And so I think once you've gotten that many trades in, you get a real sense of how this thing performs, and you're not as surprised by all the little variations in it. You don't lose your mind when something happens for the first time. I mean, because you've seen some of that stuff before. So I really think that's probably about right. Um, so number three, um, in the 2018 webinar, when I explained the 4 bullets method, and then about holding 20 to 25 positions for swing trading, and these are that shorter time frame methods of position sizing. Correct. Uh, and now for the inter time frame between these three categories, this is kind of how I would look at it. Um, I think of these in terms of position sizing, position trading, excuse me, swing trading, and day trading. So for me, the position trading, that's that monthly balancing. That's the longest I can really go without thinking about it. I might have another like an annual asset allocation if I was just starting off right now, maybe. So, um, but for me, that kind of I look at that annual rebalancing really on a monthly basis, almost like a rolling 12 months. And so, 30 years ago, I would say I was at 80, 85, 15, and 0, doing no day trading. So I was an active duty Army officer at the time. Um, 10 years later, I had migrated to something like about, so this is 20 years ago probably, 65, 30, and 5. And then 5 years after that, 40, 40, 20. And then maybe 10 years ago, 20, 50, 30. And now I've kind of settled into this roughly 20, 40, 40. Um, and I really look at this as a pool of capital that helps when you start thinking about core and turbo. Sometimes this money will bleed over into here. Sometimes some of that money will, be carried over in there. So really, the bulk of my professional exposure is happening in here, and then this peels off money out of that black box, and this grows as I skim money off of this engine. This is the engine for me here, that 40 and 40. So portfolio heat, if you had 25 positions at 0.5% to capital, total risk would at a given moment would be 12.5. And if the market accounts for 50% of price movements, which it does, and most stocks are highly correlated, if you choose the ones that are strongly correlated, I typically do that. I have a few that are not, but most of the ones that I'm looking at are either strongly correlated or strongly inversely correlated, so that the market direction provides information about both of those. But I take your point. As swing positions are held overnight, I'm also concerned about a severe adverse opening gap, which may hit all 25. What measures can we take to reduce that risk? Well, so a couple things. Notice our cross correlation of assets and make sure you actually have the diversification you assume you have. So in some cases, if you're not conscious of it, you might have positions in ETFs that are strongly overlaid. The easiest example, if you had QQQ, the NASDAQ 100, and you had XLK, the S&P 500 tech sector, you got about an 85% similarity in the largest positions there. So that's really the same position. So just by having those two positions, you don't really have diversification. The other thing to look at there is that when you're looking at correlation stats, you should also consider correlations when the market is adverse and not just during broad periods of look back. So corrections in the market happen fast. And what will happen is so if we normalize, we said this is the performance of the S&P 500 was the zero line in horizontal. What you would see is that the Russell 2000 will outperform for a while, and then underperform for a while, then outperform, and then underperform, and will generally track the S&P, but it's like, say double the volatility. And then you might see something like EFA, say the global does this, and does something like that. So for a while, it's kind of like U.S. versus the rest of the globe, as measured by EFA. And then inside the U.S., sometimes it'll be the large caps and sometimes the small caps. Well, when you look at long periods of time, you would see that correlation coefficient is probably something like 0.7 for the globals, and then maybe 0.8 for the Russell. But that's looking at long periods of time. Corrections occur in really short periods of time. Like, for instance, in a 10-day period, you might see 80% of the money that was lost in a quarter is lost within just a 10-day period. And during that period of time, everything goes down together. All those diverse correlations that used to promise diversification suddenly all get very, very tight. Now, on the daily report, the way I track that is that I track the moving correlation coefficients of broad indexes. And what I do is I say, if this is the S&P, the one that is the strongest correlated thing will be something that is tracking that thing precisely. And then there may be something that is outperforming and something that's underperforming. And so if the strongest correlation is 0.9, 0.98, and the weakest correlation is 0.6, I find that distance, and I say, right, the spread between the least and the most correlated is 0.38, right? And then the candidate that is the most uncorrelated from the S&P tends to rotate as things go through their little cycles. They move in and out of correlation. Well, what happens is when the market goes down more than 10%, when the market itself tanks, what you see is that these least correlated things all disappear, and now everything goes down together. And now the difference between the least and the most correlated among these 10 big indexes is, it's like 0.01. And what that means is that if you have an asset allocation model that presumes the long-term correlation coefficient is that diverse, it doesn't protect you when everything in the market all goes down together. So it protects you during cycle time when money stays in the market and is rotating around chasing sectors. That's fine. Diversification works there. But when everything goes together and you get sell-offs more than 10 or 20, all the way down to 80%, like we saw in the NASDAQ, the correlation models blow up. In fact, they get bad because those same models tell you that when you're down 20%, you should borrow money and pile on and buy because that always used to work. That always did used to work until 2003 and then 2008 and 9, when that would cause you to really blow up because the sell-offs were 60% and 80%, and if you were leveraged, you really got murdered. So I say all that simply to say your correlation statistics should consider what the true correlations are during sell-off conditions and not just during broad look-back periods. Now, to protect yourself, instead of just pulling your money out of the market, you could look at options or volatility ETFs as hedges, because you can, for a little bit of money, you can get a lot of insurance, and you have the opportunity to make some money on it. Now, you can also reduce position size to account for heat. You mentioned 12.5%. I think 20% is reasonable heat for a guy of my age and with like these swing positions. And that assumes, however, that I can also do some rapid hedging during the day if I had to with the day trading portion. So the final thing you could do is look at the risk Z and the ETF2 allocation model and the market classification model to say, are we approaching the kinds of conditions in which market shocks are more likely rather than less likely? And then longer term, again, is look at wider diversifications like income investing with bonds or real estate or other business ventures to smooth out your total equity curve and not just look at the equities themselves, but looking at your total income. So those are some things I think you can do. Framing in both directions. Should all trades be framed in both directions? Absolutely yes. And the reason is it is a systematic discipline to frame them the same way all the time in any time period. It builds up very good habits of mind. By forcing yourself to look at the other side of the trade, you put a wedge between your emotional commitment to the idea and your execution agent, your authority to act. And so the way I recommend doing that is in this little structure here. On a trade frame, start with what do you see, describe it precisely in terms of the indicators, and don't make sense out of it yet. But say we are at 1.5 on the Z-score, as opposed to saying, oh well, it's a relative strength leader because no. Describe specifically what you see in measurable terms. Map out what it could do, and then which way you want to trade, and then where would I enter? Where's my initial stop, my execution stop, and if it hit my execution stop, would I stop and reverse? And in order to say that, you actually have to answer these questions. What could it do? If the trade starts going the other way, what could it do? Would I trade it that way? Where would I enter? Where would it fail in that case? What could it gain? and that will tell you if the reversal or if the execution stop is also a stop and reverse. There's some times when that's not the case. For example, I might in an upward market, I may not. Yeah. So if it's starting to go up and I think it's going to go this way, and so I enter here, and I have a execution stop down here. Maybe this second red line is the previous low of the day, and so if this thing fails, and now my execution stop is hit, that may not be the place where I want to actually get short. I may want to wait to get short down here. And so there is a delayed blast in here, a region in which I have no position. And what I did was I managed my risk. I'm thinking in this pattern, if it's going to go, it should go right away. But if it doesn't, I'm just going to cut it short here. I'm not going to let it fall all the way to the point where I'm certain that it is a great short. But on the other hand, there's other times when that may be the case. Like you have this very tiny doji and you framed it up, and you put your stop in right here, and you have your entry right here, and maybe this thing was only 25 cents of risk because you were able to get this doji, and the thing has started to move out, and then it starts failing, and the execution stop might also be a good short. So it's sometimes a good idea to stop and reverse. Other times it's not. Like a 5DD, you had 5 days down in a row, and it starts to go up, and then it fails through the low of the setup day. That's always a good short. But if this was a triple screen, where you had a long, strong move, and then it pulled back and started to go, that may not be a great short right there because of the power of all this relative strength here. Maybe this is not a good short. Whereas in a 5-day down, or even better, in a washout pattern, a failure of a washout pattern, so that WOF or a 5DDF, those are certainly cases where the initial stop is also a good short. So I say all that just to say that when you think about would you stop and reverse, that answer is not always the same. It really depends on the trade that you're framing at the time. Now, the second part of this trade frame, this little process, is on a win, where would it stall? And that's like the 2R battle drill. So you've already framed that out, and you've identified resistance above. Where in the life cycle of this trade frame? So I've got my little yesterday's move, and so I've put that here. I've made my frame. There's my execution stop. There's my mechanical entry. Here is my in this case it looks like a 3R. Well done. And so price starts going up, and now I'm able to it's gone that far, so I can start. When do I make that move to preserve a win? And then if it gets up in here and starts to fail, how much of this? Maybe I was just moving along here, and then it starts to fail, so I hurry up and accelerate and lock that in. That's that 2R battle drill, and you should watch that every day for like 30 days, because it talks about how to preserve those wins after a measurable move that was good. After that move is locked off, where could it go? Well, it could come all the way back. It could come halfway back and then start to resume. It could immediately resume and go. If it breaks through the previous resistance, how far was this move? It could do another one of those to the upside. And then if it fails through the original stop, it could move another one of these same moves to the downside or to the previous support level. So after a win, I'm always thinking about what's this move look like? What's that first leg back to the entry, a second leg back down, or are there other places where it found support that would act as support levels? So what you're really doing with this trade frame is that you are rehearsing all of the standard decisions you will have to make in that space between minus 1R, the minus 1R, and then the plus 2R. And that's the essence of the trade frame. That's your professional space between the 2R and the minus 1R. If it breaks through 2R, then chances are the mouse at the next higher level time frame isn't trying to short it. He's going to start piling on because now it's a significant move and it's starting to go. If he doesn't think that it's going to go, then he may actually be looking at that as a way to squash it and to short the bump. And that's why so many of these things don't follow through after 2R. They tend to fail right away. And that's why you don't believe in them and you don't stick around. Like you don't waste all those 2R gains you just made because you believe this is the one that's going to go. Remember, that the next higher time frame has his own opinions about which way the direction is. And so if you're buying off the bottom, he actually thinks this is the higher it goes up, it's an opportunity to short, not a chance to change what the big longer term trend is. So that's why usually around that 2R on your time frame, if you get one of those, that usually becomes a move to preserve and not a move that says, oh, this is the one that's going to work. Be surprised by those when they really work big. So that will. What I have found is that this act of trade framing in this way protects you against falling in love with your ideas. The question was, how do I manage my longer term capital? I think I've answered that one already with the 20-40-40. It's like a core and turbo, but now the swing trades are the turbo, and the position trades like BMR are the core. Okay, next one, lesson 8. What decision making do I use to decide when to turn a successful day trade into a swing trade with markets money? Maybe 1/4 of the time that happens, or 1/5 of the time. And the first key is the broader market has to be favorable for a swing trade. And what I mean by that is this. Let's say here was the market, so we set up some kind of, maybe the market was in a 5DD, all right? And let's say the market itself was in a 5DD. Okay. And now, if that's what the market itself was, MKT, market. And now the market did this. It took off a little bit and started to go. On just a 5DD basis, we'd be entitled to believe that the market over the next 1, 2, 3, 4, 5 days has a chance to do this. So if the market looks favorable, and maybe my sector is strong and better than the market, and maybe I also have a company that's doing well, and that trade is taking off, I might say, you know what, the market itself put in a good day, and now there's the chance to get these to be a good day tomorrow. All it has to be is a reasonable chance for a better than average day tomorrow. Then that's a case where I might be willing to hold it. But let's suppose that we were talking about this day. So it wasn't until it was 4 days ago that the market did that, and it's had 4 days in a row of pretty good trades. And now I happen to have a nice company trade, and it does well. But I look at the market and say, hey, the market feels full. It's already coming near a resistance level, and it's going to start rolling over. You know what? I don't. That's not one that I have any advantage in. In fact, the most likely continuation is that it pauses and refreshes and then comes back to the 50% retracement. It's more likely to come back to here than it is to go to there, right? So that's what I mean by saying the broader market condition itself has to be favorable, such as the first or second day after the market itself was in channeling or overreaction. That also means that the market condition itself was probably bull, normal or bull quiet, yeah, even bull volatile, I suppose, or sideways quiet. And then I would want to see where is the risk Z in its life cycle. Is it in the spring or summer? Then probably yes. If it's fall or winter, then probably no. So what we're looking for is a suggestion that there's more follow through on the next day. And so the trades that made money today could become candidates for continuation. And what you're really hoping for was a large move today to so that a guy who saw that with end of day data puts in a market buy market at open, which might give you a favorable gap. So the market makers might say, hey, this thing had a nice, great big white candle today. And then tomorrow there's all these guys that want to buy at the open. And so they open the market here, and now you get to collect that gap. So if that was a surprise move or the first day out of a 5DD and the market itself was favorable, you might then say, I'm willing to give a play to hold to see if I can't capture that gap move for tomorrow. Okay. Question 2: what advice experience would I give for having a healthy separation of work and family when I trade at home, and also have a wife and young kids at home a lot of the day? Whatever you're doing, do it well. You don't want to. Trading is already hard. And you're making trades. Don't trade off between the family and your work. So the work is what you do as a responsible adult, as a provider for your family. And so there is a professional space that you must create and optimize, because the guy on the other side of the trade does not care about your family. He wants to eat your family because he's trying to feed his family. You got to have that mindset, in my opinion, in order to be properly prepared for the stress of trading. Now, there are other people who adopt a different frame of reference when it comes to the markets. The one that seems to work for me and for more people is that it is a combat. It is a battle. And so you do not go into that unprepared. You don't go into battle with your kids on your lap. You go into battle having done your due diligence, and you're prepared to fight for your family in the way that you know how. As a professional, as an honorable warrior, but there's a time and a place for that. So you got to create the time, and you got to create the mental, spiritual, and emotional space so that you can earn an honorable living to support your family. And a lot of the productivity tips and things that I see, Tim Ferriss probably has written on this too. You need a professional space that is dedicated to what you're doing. There needs to be a boundary between that and the rest of the family space. You need to honor your family and do those right things, but when it's time to work, you go to work. That means you got to shave, put on clothes. You got to go through your pre-game rituals, whether that's doing some time on the stair stepper and getting a run in and getting your mind right and be ready to trade. And then when you trade, you trade. And when you're done trading, you debrief and you take care of all that business. And then when you're done, you come home from work, even if your office is in your home. And so by honoring the time you spend with your family, the way you honor that is by honoring the work you do also. The work allows you to have the opportunity to spend quality time with your kids without stress. And so to do that properly, to honor your family, you have to honor the work. And by incorporating your family into the things you do and talking about that work, you don't get that sense of isolation. Don't shield them from it, but let them know what it is that you do and why it's important and how daddy prepares and what being a professional means, professional grade and due diligence. So all of those things, protecting your space, organizing it properly for work, make it a place that you're proud of. It's your office. And if necessary, get out of the house. Go rent a room at your neighbor's house or at the library or in a small 10 by 10 office somewhere where they have a bulletproof internet. You don't need much room, but that's what I think about that. Okay. Be professional. Professional grade and due diligence. Next, could I just trade the XL sector series and big indices to learn the ropes of swing trading with the RLCO and RLFF, but with less symbols for ease of management? Yes. If you take a look at those, when you go through those videos, what you'll notice is they're all the same patterns. And so when you get all the way through those and you get down to the XLs, you'll recognize that Alcoa, Caterpillar, Home Depot were all trading in the same way as XLB. It was the same thing. XME was trading in the same direction. That's just 5 different symbols all trading the same way. So you can simplify your life. There's enough diversification in the XL series, plus a few other ones, that you can stay just at the market and sector level of detail. And then once you've mastered that, you'll always be able to find the thing that's moving in terms of the sectors. Once you get that habit down, you can then drill down into the sectors like I do with the radar screen and logic chain, and then find a few more that when the tech sector is going, these go a little bit further and faster and farther, or using the leveraged ETFs to represent those sectors. So I would start with that way, and you will reduce your span of control and the management challenge. But I start from the inside. Start with the S&P and then work your way out. And if you look through that logic chain, then you'll see what I mean. In my portfolio review videos, I mentioned momentum stocks. Do I have a specific criteria? I would define it this way. I don't know that I've written it down that way except here. They are well primed for short-term bursts of 1 to 5 days in the next leg of a swing trade, as opposed to relative strength stocks, which I would like you to think of as long-term strategic journey with above average performance and that are just chugging along like these large trains carrying the mail. They don't explode, but they just have persistent gains in one direction. And maybe they're not running, they may not even be outperforming on any given day, but the aggregate over days, weeks, and months is favorable. Whereas a momentum stock, to me, is one in which something just changed, and now there's a swing trade in play that's going to rapidly alter the pricing action, get it back to the new fair value. So you get a sharp move with momentum that attracts momentum buyers and sellers until that thing runs its course. And that's what the swing trades really are. The swing trade candidates take on those characteristics as opposed to the monthly asset allocation types. Okay? So that's how I would define a momentum stock. Number 5, when price is making an all-time high, how do we determine the target level to find a 2 to 1? Well, there's an implied 2 to 1 in there. There's at least, if it's an all-time high, there's at least 2 more ATR above it. So even if you use a 1 ATR trailing stop, you can assume that there's more gains above. To get more precise, what you can look at is the technique of the RLFF as an example. You can look at this and say, find a blue in here. So we treat the RL10 as price. I should have drawn the RL270 first. So maybe it looks like this. That's pretty extreme. So what I might say is, how far above the RL10, how far above long-term fair value did this thing ever get? And so you say here it got this far before it sold off, and then it surged and made a new high. When it took out this high, it just made a new high. And how far above? Well, you could either measure this one from the previous high to the new high. It made that far, and maybe the RL10, RL270 went that far, and now you're at this position. It just made this made this little run, and now it's coming back into the station. Now this time it only got this far. Oh, darn it. It only got this far and is starting to roll over. But if it takes off, I could say something like, well, let me assume that it could go this far above the RL 270 and then simply project here, and I could now establish a price level that says it could get that high in that next time period. In that next time period, it could maybe do something like this. And so this is my reasonable reward. Or you could just say, hey, at any time there's a new high on a swing basis, there's always another 2 ATR above philosophically, because it'll take all of these swing trade momentum traders who are deliberate and who want to come in and chase. That's like the fourth and the fifth mouse. So you can always say that. So you could take a look at either how big was this move from here to here, from high to high, or how was it from RL 270 to the peak of the 10. And I kind of like that one because I think of the buy and holders are that RL 270, and I think of the RL 10 as the traders. And really, that next leg up in a swing trade is really about how far can the traders push it above the current fair value before they all run out of money, and then it becomes time for it to roll over again. So the next leg up, you can just measure the size of the legs, take a look at the previous history of excursions from the 270, or just take 2 ATRs and say, at least there's that much in there, and then just play that by ear. That's always hard to do, but there you are. Like I said, it's a good kind of a problem to have. When finding the strongest sector to jump on, is it a matter of simply using the 1 week and 1 month? I would say good place to start because that's the BMR. But you could also look at the ETF2 database and then also the RLFF framework and see where they are in the life cycle. But that'll get you there pretty quick. I mean, you could make it as complicated as you want, but that's pretty good. You'll never be surprised if you do that, especially the ETF2, because that gives you a sense of how long it has been strong, because it's a 10-week moving average of strength. A 1 week outperformance might not lead to a persistent advantage, but if you see something that's green or white on the 10-week or on the consistency, then that thing really has been persistent. You can look at the NDX. I don't say it in here, but you can look at the NDX numbers on the daily report too for that. There's a 3, 6, and 12 month performance levels too. What's the advantage of hedging core positions versus simply selling part or all of the positions? It really has to do with a couple things. The hedge actually lets you earn some money. All right. So if I have this much in the market and I'm concerned about an adverse move, well, if I sell some of the position but it works, then I'm only winning on that portion, and I didn't get any of this. But if I'm not hedged and it goes against me, then I'm actually losing on that performance or on that amount, right? So it's an actual loss. It's losing less than the whole position, but it's a loss. But if I have hedged, I still have my whole position, and the hedge is making money on the way down. So it goes down, the hedge is making money, and that might be enough to either offset the losses or even make a little bit more. I like to normally just keep it market neutral. So it's actually making money enough to offset the loss, and that way at least your equity curve is flat. And then when the long-term relative strength thing kicks in, you can simply take off the hedge and now you're gaining money on the big pile, and there's no tax consequences because you didn't sell any of those in your longer term account. So you have a full position on, and this thing can keep going. You might even take some of the money earned from the hedge and put it back on and say, oh, now that this thing has moved up, dip, and it's going again, now I can actually use the money I made from the hedge to reinforce this with either a pocket trade in here or with an emerging dragon. And then when you get these long, steady pulls in those relative strength ones, that's a way that you can use essentially core and turbo to improve your positioning. Let's see. Last one. There was a difference. I think this was yours, Glenn, or maybe it's Griff. Probably a slightly different look back. You looked 2683 days of data. I'm using probably 5,000. And on that basis, there could be a micro difference in the standard deviations and averages. I don't think those things are significant because you're really talking about thousands of days that establish long-term gain or long-term standards that are very, very stable. And the ZVIX or that risk Z is sensitive to we're looking for short-term differences in volatility against very long-term lookbacks. So I think you'll see that the relative patterns probably line up pretty well. The interpretation is the same, but the actual detailed computations to the fourth and fifth significant difference are probably are a little different, but they're not significant. So that's how I would treat that. Okay, that's everything that I wanted to cover tonight. I would just say, let me just take a quick, just at a couple of the, I'm not going to go through all of the portfolio things, but just to show something about like Alcoa. Alcoa has been just grinding along, doing nothing in this period. So there was this long period of time when Alcoa was great, from here to here during the initial bump, and then it's just been grinding. And now we got this really nice move. I got the second position in last Friday, and then I cashed that thing today right up in here because this felt like 1, 2, 3, 4, 5, 6, 7, 11 days in the MACD histogram and the PSAR. 11 days in the PSAR. You can see we've gone from a pinch to a fully exposed or expanded stretch. And look how that thing has opened way above. That's about as far as it got last time. And it was done. And then it rolled over and did all this crap. So this is a perfect example of that previous discussion that says, you know what, this is far enough. It was a venture that if it was going to explode, maybe it would go. It didn't. So I'm quick to harvest that 2R and be done with it. Apple is kind of a similar thing. There was a really nice long-term move in here and then a pullback. And now it's done this little move. It got to a measured resistance level back to fair value at the RL270. And what does it do? It immediately rolls over and then comes all the way back to the previous support level. So if you're not quick about locking them in when you get them in this sideways volatile kind of market, you're going to always be giving back those things. And that's the idea behind that ruthless risk management that I talked about with Kim Anderson, which said, when you have an outsized gain, don't let above average wins become negative. Try to preserve those gains and then make micro improvements. And that made all the difference in her equity curve as expressed over hundreds of trades. Just that little nudge of psychology made a huge difference. Okay, so that's everything I wanted to cover tonight. I'll get this thing processed and posted in the right board in the usual place. And I have a residential course coming up in Raleigh or at Cary with Van Tharp Institute starting, I think it's Friday. It's Friday, Saturday, Sunday. We got that going, and usually something interesting comes out of that that I will be able to add to our work. But keep up the great work. You guys are doing superb in the collaboration. It's the crosstalk and fitting it to your own psychology, that talking it out. That's really valuable. It really helps you take ownership of the ideas. And Hugh, and I'll see you when you get there as well. I'm glad you had a chance to listen in on tonight. This is sort of typical of what I try to do with these weekend ones, and this is we'll talk about this one again when I see you in a week. Okay, guys, take good care. Be safe out there. Cherish your families, and treat yourself gently. And good night. Let's see. Stop.